Hello, everyone, and welcome to the program Business Point on Global Television. I am Samuel Odi. Many thanks for joining at this hour. On today's edition of the program, we'll be looking at stock exchange, stock brokerage, and risk management. Strategies employed to mitigate FX exposure. Those are the angles we'll be looking at. But before we get into all of this conversation for today, let me bring you up to speed with the Nigerian Stock Exchange. All share index rose by 0.23% to 96,433.53 points as of September 6th. The top gainers were Oando UAC of Nigeria. Top losers were Deep Capital Management and Trust, PZ Cousins Nigeria, Etana, and Collegiate Hallmark Holdings. The Nigerian Stock Exchange market capitalization is currently at 55 trillion naira. The trading summary of September of the previous week was the total volume of 30 shares traded at 386 380,650,000, and then the total revenue value of shares were traded at 808.466,303 points. Number of deals are at 7,901. Number of gainers are at 39, and number of losers are at 18. So for all of this to happen, for all of these gainers and losers, and then the total shared, there are a lot of risks and then exposure that has to do with FX. So on today's edition of the program, we'll be explaining all of this. But before we dive into the conversation, I'll be introducing my guest who is joining virtually, who would help us understand all of these angles and how we could, mitigate and then, see a way out to escape those risks and then manage. Definitely, you can't just escape the risks, but you just be able to find ways that would be able to manage all of those risks. Just stay with me. We'll be right back after this quick break. All right, thank you so much for joining. And Action Samson says, good morning, Mr. Karim, David. Thank you so much for joining at this time.
Good morning. Thank you for having me. Thank you very much.
Yes, it's an honor. As a Karim David is a business analyst who's also a mogul when it comes to the forex and then stock exchange market. So he's more basically like a stockbroker. So, Mr. David, let's get into the conversation. Given the fact that we are looking at stock brokerage, risk management, and strategies employed to mitigate FX exposure. So, since we're looking at all of this now, basically we want to know what are the primary risks management and strategies that can be employed by stockbrokers to mitigate market risks and as well as also credit risks.
Okay, thank you very much. You see, basically, we have a broad classification of risk when it comes to stock brokerage. So let's start from the top side, regulatory risk. That has to do with regulatory authorities that the stock markets or the stockbrokers or stockbroking firm has to face. Then we come down to operational risk. That has to do with the processes, internal processes of the company itself, what they put in place, the system that they run that facilitates the brokerage services. Then we come down to what's called a market risk. So market risk, if I get you very well, is what you are talking about the other time. It's essentially about what happens when the asset prices move against you. Was possibly sometimes it could be very serious when the asset the broker is involved in or is leveraged. In other words, they borrow money and add it to what they have to take positions. So that could be market risk that a broker could face. We equally have reputational risk. So that one has to do with like maybe customers are complaining about your services, or maybe there's a scandals that is negative publicity from the media. So these are essentially, then we have the credit risk as well, which is the counterparty risk. What if the broker has to have financial transaction with a party and they fail to honor the obligations? So there are layers of risk and diverse in nature or that a brokerage firm can face. But what we see more often than not is about the market risk. Oh, that's why you are giving analysis the other time about the capitalization or capital market or index falling here and there. So that's the asset movement, the price movement of assets. So because of the far-reaching impact of such situations, so it tends to go viral. So what we need to look at it very well is that underneath is all these things are things that lead up to that. For example, when you have regulatory lapses, it's give a brokerage firm to take positions or take some actions that could lead to a serious consequence, not only for the firm or the assets of the firm or to the client's confidence, even the entire market as a whole. So there's a kind of interconnectedness or the kind of connection between those things that leads up to what you see in terms of a player in the capital market. Thank you.
To bring to the implementation and position season and portfolio devaluation to maximize exposure. So how can all of this now help individual stocks and then the sector?
Now,
by looking at portfolio diversification and then maximizing exposure to individual stock or a particular sector. If you're looking at it from the Nigerian scene now.
Now, let's look at it this way. Okay. Thank you very much for that. Diversification is just, we are trying to say that spread your capital across asset classes, across geographies. Just time. So that's what it means. So what is is so that in case maybe there's a correlation you have to assess. If when you have a market crash or market situation whereby you have a swings of movements of prices, you need to be careful that not all where you position your assets are falling. Some should be falling and some should be rising to cushion the effect. For example, bonds and stocks. They tend to have some kind of negative correlation. All things being equal, not the market collapse like 2008 that we had financial crisis, or normal situation like that. But what I'm saying is this, that as a portfolio, in the concept of portfolio, what you need to do essentially is to make sure that you spread to handle that kind of risk. First of all, you diversify. You don't just concentrate your risk on a particular asset class, for example, securities, your stocks and bonds. You can look at commodities as well. You can also look at currencies. So these are another asset class. You can look at options, contracts, straps, just time now. So there's a way you can spread your asset. Maybe some of these I want to go into real estate, like real estate. You can spread your asset across asset classes. Then there's a question of geography. Now, if I put all my assets in Nigeria economy, for example, and there's an issue, or in US economy, for example, definitely because it's concentrated in a particular location, a particular market. If the market has issues, I will be involved, and it will be very serious. So that's why you see some people, in terms of portfolio, they diversify from developed economy to emerging economy, like China, like Brazil, like Russia, like South Africa. You just have to look certain criteria to make sure that your portfolio is well hedged in terms of the fact that you put your asset across your capital across asset classes, then you diversify across geographies, different location, different market, different asset class. So that's what it's all about. Now, I need to point out here that it's very important that when you are diversifying, find out where there's a correlation, because sometimes when there's a global situation, it's equally going to affect your assets. So are they correlated? If they are negatively correlated, fine. But the situation whereby they are positively correlated, what it means is this: when the price of this one that you put in Ghana is rising, the one in Nigeria is equally rising. But when it's falling to Nigeria, one is equally falling. You need to structure it in such a way that you can hedge out risk. Now, there's something I want to indicate very well. It has to do with a structured trades. Now, structured trade simply means that within an economy, for example, but for Nigeria now, we have different sectors. We have maybe health sector, utility sector, telecom sector, communication sector. We have financial sector. We have energy sector. So when you have all those sectors, then some of the way you can diversify them is what you can have a structured trade. Now, if it depends on the business cycle, actually. If the business is booming, for example, the economy is doing well, so you can put certain assets in cyclical stocks, like maybe or cyclical stocks that move around, like consumer discretionaries, like cars or automobiles. So you can look at sector like that and put your money there. So, or financials, it's part of cyclical sector as well. So, then you can put others into defensive stocks. Even though, what I'm trying to say, within the stock market, you can have a structured trade that some of the asset class, like utility, for example, healthcare, is a defensive stocks. You can put some stocks there. Then some other ones that they swing based on the market fluctuation affect them much more than the other one that are defensive. That's why they call them defensive. You put your asset there. Depends on the market cycle. So when you have that kind of structured trade, we call them cross-sector. So that is what cross-sector trades. So across sectors, not everything in one sector, because it's not nice for someone to say, I'll put one money in GT Bank, another one in Zenith, another one in FCMB. It's fine, but they're all in the same sector. So that is one thing we need to understand. So consider maybe, for example, now, aside financial sector, telecom sector, look at MTN, look at conglomerate, look at Dangote, for example. So you spread your asset within the stock market, even across sectors, not just everything in one sector. So we need to take note of that as well. Then I would like to quickly indicate another thing. There's another thing we have what we call cross-sector spec trades. So, sorry, can you come again?
Business Point on Global Television.
The business world can be dynamic and unpredictable, with headwinds and volatility sometimes becoming an obstacle for players in the business and economy landscape. Watch Business Point on Global Television as Samuel Odi walks you through the twists, turns and curves in bonds, stocks and crucial market indices from a global standpoint. Watch Business Point weekdays on Global Television at 11 a.m. West African time. Business Point. This is business.
Many thanks for staying with us, and we're still waiting on our guests to join. But before while we're still waiting on him, he made mention of diversification of, stock investment and all. So not focusing on one sector. That is, we have several sectors here in Nigeria. We have the oil sector, we have the financial sector, we have the agricultural sector. So to be able to manage risks and have a very, good returns on your investments, you have to diversify, given the fact that if you want to do a financial get stocks in a financial firm, you need to not just put all your money in, maybe for instance now all of these banks that we have in Nigeria. You can just go for maybe First Bank, GT. You can do First Bank, or probably then do another different organization that's different sector, meaning going to probably the communication sector or the agricultural sector. All of this is just going to help to manage risks. And then what role does stop loss and as well as limit order helps in strategies in playing and managing of risks. So all of this happens in the same form of diversification of your investment and stock planning. So all this plays a massive role, because the moment you diversify, you'll be certain that you'll be getting returns from different sectors and then different investment platforms. When all of this happen, you would be rest assured that, okay, even if A didn't work, probably B, C would work. So that is what investment is all about, not just having all your eggs in one basket. So diversification simply means not putting all your eggs in one basket. Moving away from down, looking at stop loss now, order, and then limit order and order trading strategies. Looking at the bar chart, and then if the chart is going on a bullish side, that means you should just always look out for a spike and where it's going to break out. In terms of breaking now, you should have an algorithm that is monitoring all of that, and then you should have a chart that you would use to monitor. When that spike happens and then it hits maybe a certain point, you should be able to figure out when next the market and then the stock is going to in the next few minutes. So with that, now having those informations and knowing the strategics of placing trade and stopping loss, and as well as limiting orders, you would be able to crop down the amount of risks you're taking, manage with the strategy, and then the moment you do that, at the end of the day, you would be the one to be smiling all the way to the bank to cash out or cash in your return of investments. This is how much time will permit us to take on today's edition of the program. Mr. David Karim, thank you so much for taking our time to join us on Business Point today. My name is Samuel Odi. I'll be seeing you again tomorrow. Bye for now.